Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Welcome to Game Plan for Retirement, presented by Chris McIntire, Northwest Ohio's retirement planning resource.
And welcome into the program. This is your Game Plan for Retirement with Northwestern Ohio's resource for a common sense approach to planning for your financial investment and retirement future. He is president and founder of McIntire Retirement Services. Chris McIntire here with us, a self-proclaimed tax geek. And if we are talking about our financial investment and retirement planning, Chris, taxes always have to be part of the conversation, as they will be today, as we talk about 6 stealth taxes that can sneak up on you in retirement. Taxes are a must address element in planning, aren't they?
Yeah, they certainly are. And some of them are easy to spot, like income taxes when we're getting paid or taking an IRA withdrawal. And then we have some other ones that are, kind of have that stealthy behavior to them, if you will, Peter. And I look forward to talking about this today.
Well, we always appreciate your insight, Chris. This is something that you have continued to discuss for quite some time, for really many years here on the program, is how to keep more of our money, which is a big goal, I think, for proactive savers and investors. We've built a good amount of money up, and we don't want to overpay in taxes. I don't think most people mind paying their fair share, but a lot of us feel like there are opportunities to decrease what we are paying, and we may, if we miss those, overpay our fair share. So, ladies and gentlemen, it's part of the planning process there at McIntire Retirement Services. If it's part of the planning process that you have not had conversations about, that you have not addressed, man, you may be missing a large piece of the picture, and it's probably time to be proactive about that. Pick up the phone and give Chris McIntire, McIntire Retirement Services, a call, 800-868-1194. That's 800-868-1194. 800-868-1194. Chris, let's start from the highest level, being that when we make the transition, as you said, from that W-2 income to retirement, the tax situation really undergoes a fundamental change where we are more responsible on our own for paying those taxes rather than our employer just withholding it before we even see our money. That's a shock to the system and takes some adjustment.
Yeah, it certainly can. And, we do some coordination with some CPAs. And I've got one that, brought up an interesting analogy when it came to Social Security benefits, for example. And, clients that are taking their Social Security benefits, he advises them to not have any taxes withheld from your Social Security benefit, because sometimes you get some different treatments because it's a Social Security benefit versus an IRA withdrawal. So, I think we'll be adapting that analogy over the course of the next couple of years when we meet with clients to say, hey, when you started taking Social Security, did you have taxes withheld from it? And maybe you shouldn't, and we'll take taxes out of someplace else, like your IRA withdrawals, because some of the special tax treatment that Social Security can receive that an IRA withdrawal does not.
And Chris, quite frankly, maybe a little bit easier to make adjustments when we are withdrawing from our own accounts versus trying to make any changes with Social Security. So get it set the right way, and then whatever we have to account for, do it on our own side, right?
You're absolutely correct. So we use TD Ameritrade, Charles Schwab, and it's very easy to adjust the tax withholding versus dealing with the Social Security Administration, a big government bureaucracy. It's much easier and can respond a lot quicker. And less government involvement, the better.
I was just about to say, Chris, the country was founded on the fact that we wanted to get away from excessive taxation. And I think we are still of that mindset today. And yet, however, there are some stealth taxes, some hidden taxes, some surprise taxes that sneak up on people in retirement. And in fact, one of them is sort of a recent implementation and occurrence, and that is a set of laws that was passed in 2019 that went into effect in 2020 that really changed the landscape of taxation on our retirement accounts.
Yes, and as part of the Secure Act, which means setting up every community for retirement, an acronym. And what it said then, Peter, was that, when an IRA gets passed to a non-spouse beneficiary, so like a child or grandchild, brothers or sisters, that type of thing, anybody you're not married to, is it must be distributed in full by the end of the 10th year of the passing of the person you inherited it from. So an example is, if my dad passes away and I'm the beneficiary of his IRA, I have to empty it within 10 years. In addition to it being a zero balance at the end of 10 years, okay, I have to take a little bit out every single year just in case, that the IRS gets a little bit of their money every single year. So call it a required minimum distribution, even though I'm 58 years old right now, I would have to take a little bit out every year and make sure at the end of the 10th year that account is completely closed to avoid any sort of penalties. But I've got to pay income taxes on that money on top of all the other income that we earn. So in many cases, for somebody that's got a 58-year-old child that's working, okay, pretty good chance that they're at more closer to their peak earning years than they are farther away from them, like when they're 25. And so the last thing they might want to do is, inherit a $500,000 IRA. And just for example, it's got to be emptied in 10 years. So they got to take $50,000 a year out of that to try to do their best to spread the taxes. So there are some unique challenges that the government has put in our lap by signing a piece of legislation into law.
Forcing people to take those distributions over a shorter period of time, Chris, that additional income could bump us up in our tax rates and brackets. It's almost like it's a de facto element of an estate tax here.
It truly is, or, essentially it's a tax increase, if you want to call it that way. And that's why you said a stealth tax, right? Many people say, we don't know when parents are going to pass away, and all of a sudden, wham, we get hit with this. I get a windfall, wonderful. Oh, the windfall, 30% of it's going to go to the Internal Revenue Service,
Mm-hmm. And that's a good point there, Chris, is that, yes, we've saved this money and built it up, never paying tax on it. That's really the dollars that we're talking about here, is those tax deferred account balances. And a lot of people do kind of concern themselves with that estate tax, but this is income tax. This is the highest level of taxes that we paid, and the IRS can easily become the biggest beneficiary if we pass on those tax deferred assets to maybe 2 or 3 beneficiaries.
Yes, absolutely. And, this is where beneficiary planning can come in very handy. So let's say a husband passes away and leaves, and has $1 million in an IRA account. And typically we're going to make the wife the primary beneficiary because she can take it out whenever she wants to. They don't have that 10-year rule because they're spouses. Okay. And if in this particular case, they didn't, mom didn't need all of that money, you could have named your children as, maybe if you had 2 children, say, all right, they're both going to get 25% of that IRA, mom's going to get 50% of it. Okay. Now they got 10 years to take out dad's portion that they received. Mom lives a healthy life. She passes away. They inherit what's rest of her IRA, and then they got another 10 years to stretch mom's money out. So a couple of different ways. I know that can be hard to listen
I
to
get it.
on radio.
Rather than getting it all at once. That makes sense, Chris. That's a way that we can further spread that 10-year mandated required distribution and try to effectively manage and lessen the taxes. These are some of the strategies, ladies and gentlemen, that you can benefit from with the qualified, experienced eyes of a advisor, someone who has seen this and learned the strategies and can help you to identify where they may be valuable and implement them along with you. So if you would like to get that plan put together where you may identify ways that you can be more tax efficient and save and preserve significantly more of your money, pick up the phone, give Chris McIntire a call, get that game plan for retirement. 800-868-1194. That's 800-868-1194. 800-868-1194. And I want to clarify something. I think I'd be remiss if I did not mention, Chris, because we talked about those tax deferred IRAs being subject to this 10-year required distribution. But even though they've already been taxed, Roth IRAs subject to those same requirements.
Correct. Yeah. Inherited Roth IRAs also have that 10-year distribution schedule as well. And these are legislative issues that could potentially change down the road, but, there's some harmonizing of the inherited IRA rules that they wanted to get in place. And, being that we're on that subject, you cannot take an inherited IRA and convert it into an inherited Roth IRA, right? So, there's some pretty restrictive pieces here. That's why planning is so very important here. And none of us know the day we're going to pass away. So the earlier and the more often you keep up to date with all of these plans and beneficiary designations and whatnot, and sometimes it can make sense to name, grandchildren as beneficiaries as well, because you can help them, if you want to give them money, but you want their parents to distribute it to them, it may make sense to, allow them to be a part of that beneficiary designation as well. Now, that being said, I wouldn't want to give an 18-year-old $100,000 because he'd probably be driving a new Corvette or something like that.
Well, it's going to force that they distribute it over 10 years. So even if they are prudent savers, responsible individuals, which, as you said, 18 years old, Chris, whose mind is in the right place at that point in time, but they have to take the money out. So there's kind of the motivation that that Corvette is looking not tempting there. But not only the income tax, Chris, but if we do not abide by that 10-year distribution, an additional level of stealth tax assessed, the excess accumulation is a tax of 25% of the balance plus the income tax for any funds that remain after that 10-year window closes. So we got to make sure that beneficiaries are aware of this and fully abiding and adhering to those requirements, but you've got to plan ahead of time to make sure that that does not create excess taxation on your hard-earned retirement dollars, ladies and gentlemen. Pick up the phone, give Chris McIntire a call, learn more about this, and make sure that you have discussed this as part of your plan. You don't want to pay more unnecessarily. So 800-868-1194, 800-868-1194. Number 2 on your list here, stealth taxes in retirement. Chris, the taxation of Social Security retirement benefits. Are a lot of people surprised by this?
I think more and more people are aware that this potential is there, and they've been taxing Social Security benefits, for a very long time. 1983 and then 1993, they taxed even more of them, and I would certainly think that this is on the table. That for higher income folks, they're going to pay tax on all of their benefits. So to keep it simple on the radio, there's you can pay income tax on up to 50% of your benefits, and it can ratchet up until 85%. Okay. Now those numbers where those come into play have never been adjusted for inflation. So imagine, $32,000 in income for a married couple in 1983 is not what $32,000 is in the year 2023, 40 years later. Think of what inflation does. So more and more Social Security benefits are becoming taxed, and then that revenue goes back to the Social Security Trust Fund to help keep it. Yeah, it's supposed to. Yeah, to help keep it solvent for the long run. And obviously, it's got some long-term funding issues, and we'll put that on the back burner for today's conversation. Okay.
Chris, do you mind? Are a lot of people, because of that news, are you seeing people panic claiming Social Security and maybe unnecessarily doing so, and then as a result, maybe incurring penalties and taxations on their Social Security benefits where they otherwise may not have had to?
Oh, yeah. Yeah, most definitely at times. And the wealthier someone is, the more likely they're going to take Social Security early, because they're going to be concerned that they're going to be legislated out of it, or means testing, if you will. And they may say, just as an example, they say, hey, if your adjusted gross income is $200,000 a year or more, you don't need Social Security, so we're going to phase it out for you. That would be something called like means testing. And there's nothing, set in stone that that's going to happen, but that would be an example where it would come into play. And then, on the other side of that, I might get somebody who's 65 and they want to wait until 67. Maybe that's their full retirement age to take their Social Security benefits because they need to maximize the monthly benefit that they're going to get for the long haul. They may say, I'm going to live out of my 401k for 2 years, and then I'll switch over to Social Security, lessen my 401k load, but I'm going to get more money out of it. So, there's still two different tails on it. And, I think folks on the lower side of the income in retirement aren't as concerned about the funding of Social Security or their receiving benefits as the upper income side is, from a legislative aspect, and then obviously the long-term funding side of Social Security, or the deficit, if you will.
Yeah, interesting. Although I think that we all need to pay attention to that news, and I believe, Chris, probably at some point in time, probably like a last minute kumbaya, like the recent debt spending limit debate, they'll reconcile some kind of package that actually addresses this issue, but it may be some time. And when you speak of the taxation of those Social Security benefits, Chris, awareness of that potential versus the reality of actually seeing and experiencing it, kind of two different things. So yes, while people may be aware of it, still can catch people off guard and be a bit of a surprise in retirement. So again, these are things that we need to plan ahead for, Chris, because if we plan on gross numbers, but we actually only get to spend those net numbers, there can be a big difference there when you talk about the impact of just the taxation of those Social Security benefits.
Yeah, no question about it. I mean, it can be significant. And, some people can look poor on paper. They can take money from a Roth IRA, which isn't taxable. So, when they do their tax return, it doesn't look like they've got much income, and they don't pay any tax on their Social Security benefits. Okay. Or they're living out of a checking account for a couple of years. Okay. Then all of a sudden, they hit age 73, required minimum distributions kick in, and they've got to pull 60,000 out of an IRA account, for an example, and now pay tax on 85% of their Social Security benefits. So that's kind of that double whammy there that you're referring to, Peter, or at least an example of one.
Yeah, absolutely. But again, there are strategies that you may need to take a look at that can help you to offset it or minimize it, ladies and gentlemen. And a lot of them do take some preparation, some planning, and some looking forward. So that's why you've got to have that game plan for retirement with the help and experience of a proactive, qualified advisor. And Chris McIntire is that resource. Offices conveniently located in and across Northwestern Ohio. Get the conversation started. Get your game plan for retirement put together. 800-868-1194, 800-868-1194, 800-868-1194. And just by having that plan in place, maybe you can identify and address and avoid a few of these stealth taxes. Paying less in tax is the equivalent of earning or keeping more of your money. So certainly beneficial, a value there. By the way, no cost, no obligation to get the plan put together. So it's just an investment of your time to see if there are opportunities to do better with your money into the future. That's what the game plan for retirement is all about. Give Chris a call, 800-868-1194, 800-868-1194. Number 3 on the list here, Chris, stealth tax number 3, increased Medicare premiums. Part B and Part D, Chris, are essentially also means tested, and we need to be aware of that.
Yes. And what Peter means by that, folks, is that the more your income is above certain thresholds, the more that you pay for your Medicare Part A expenses, and also Part D. Part A is Part B is the piece I'm referring to. That's what gets deducted from your Social Security benefit. Forgive me there. And this year it's $164.90, okay, unless your income is up. over their specific thresholds, and there's several of them. And so I have several clients that, they just, they wanted to buy a house or a big major purchase and ended up pulling money out of a 401k and went above certain thresholds because that's what they had to do. And then all of a sudden their Medicare premiums also increased pretty significantly as well. And, but again, that's kind of a stealth tax, that bites you. Or if you make a lot of money and you're going into retirement, they're looking back on your income the last 2 years. So, you need to try, maybe it makes sense when you sign up for your Medicare that you work with your agent to say, hey, I'm retired now. I'm not going to make $250,000. My income is going to be 50,000. Is there anything we can do, beg for forgiveness so that I'm not getting punished for something that has already happened?
And Chris, that seems to be an area where there are actually some reasonable people behind the curtain at the government. If we have retired, if our income situation has changed significantly, they do take that into account. But you've got to go through a process to do that, right?
Yeah, absolutely. And, doesn't mean it's always going to happen for you. And, for some folks, I got a client that will probably watch this show. It just wasn't worth them going through the argument. They said, look, we'll deal with it, and it's not, I don't want to fight the government and get into all of that. By the time we get it fixed, it's going to be said and done. And my income, I'm going to go back to what the average American pays. So for them, it wasn't worth the hassle.
All right. Well, we are talking with Chris McIntire. We're talking about stealth taxes. These are things that you should address in planning, things that can be avoided or minimized if you do have a proper proactive plan, like the game plan for retirement, ladies and gentlemen, allowing you to identify ways to keep more of your money. Chris McIntire, McIntire Retirement Services, home of the game plan for retirement. It's where you can get your specific written document, your game plan for retirement, put together. If you are a listener to this program within the sound of our voice or viewing our podcast online, you are welcome to give a call, get the process started, have a conversation about your situation, your goals, and get that plan put together with the help of an experienced, qualified advisor, Chris McIntire, and the team from McIntire Retirement Services. Pick up the phone and give a call, 800-868-1194. That's 800-868-1194, 800-868-1194. Number 4 on the list here of stealth taxes, Chris, net investment income tax, yet another surcharge if we make too much money. It seems to be a running theme.
Yeah, it sure does. And, they've this was part of how they fund the Affordable Care Act, if you will. And, it affects high net worth individuals, typically, north of $250,000 of net investment income. And they have to pay 3.8% surtax, okay, or an additional tax, if you will, on that investment income that they have, or investment gains, if you will. So, you sold a commercial building and made a boatload of money on it, then you might have to pay an additional capital gains tax, is kind of what we're talking about here. And, not too awful many people have to pay for it, but for those that do, I think, what is it, Peter? What's the number here? If you're 50% of Americans pay income taxes, 50% do not. The top 5% of income workers in the U.S. pay an extraordinary amount of the overall income taxes.
I forget the exact number, but it's 85 plus 90%, somewhere in there. Yeah. The top ones pay the most, certainly. And, we hear, Chris, about how the wealthy need to pay more. Well, the wealthy do. Now, the size of their assets, Chris, is astronomical compared to kind of the average or median. But at the same time, I have also heard that basically if we confiscated the wealth of the top 5%, Chris, it still wouldn't pay to operate and run our country for a year. The bulk of the wealth is still within what is a much, much larger pool of middle class, right?
Yep, absolutely. And the way, we have a progressive tax system, the more you make, the more that you pay. And, it depends on the argument that you want to make. Do the rich need to pay more? And that's one argument to hear out of our legislatures. And I'm not going to take that argument on here today. But
as we've already talked about, even within the middle class, we've got these stealth taxes that we're going to potentially run across, Chris. The taxation, the additional taxation of Social Security benefits, Chris, those levels start at $25,000 of income. That is not the uber rich. That is the average American. That's even like lower middle class kind of income there is going to be affected by these additional provisions where if you make too much, you pay more in taxes. And the tax system itself is a progressive tax system. The more you earn, the higher tax bracket you fall into. Medicare premiums, this net investment income, all of these are additional layers to that component, to those elements. And then, unfortunately, Chris, if we are married and then our spouse passes away, guess what? There's a stealth tax there as well. And I know that you try to help people be aware of that and then plan for that early on in retirement.
Yeah, Peter. And, tax planning is so very critical, and the more money you have, the more important it is, obviously. And, that's where we'll get into, Roth conversions, creating things that are tax-free. The cash value aspect of life insurance is incredibly tax-friendly and when it's done correctly, and it doesn't show up on a tax return, where a Roth IRA withdrawal shows up on a tax return that you took the money out, but it doesn't show up where it's taxable. Okay. So if you're a legislator and you're thinking, you know what, we're giving people subsidies for their health care, and they're living out of their Roth IRAs or their savings accounts. It's like this guy's got $3 million and he's getting a subsidy for his health care. So maybe we need to scrutinize the tax return closer or the overall net worth picture that they have. And, those are things that would seem very much common sense, that someone with millions of dollars should not be getting a healthcare subsidy. My wife and I pay $2,000 a month because we can't hide any of that stuff, right?
Yep. There are different elements that certainly need to be considered. But again, Chris, all of these stealth taxes we should be aware of, right? No matter what the situation is, no matter what the income or net worth is, we've got to sit down and identify which ones we may encounter, which ones may apply to us, and plan strategically to try to control that tax bill when and where possible. And for the majority of Americans, the very first one may not be as stealth, may not be as hidden, but is often forgot about and overlooked, which is the fact that we're going to have income tax on the majority of our retirement withdrawals in retirement. That's where that planning really comes into play, right, Chris?
Yeah, it certainly does, and even if you're just in the 15% tax bracket, that's 15%. And, on $10,000, that's $1,500 that you don't get to spend, that you're giving to the Internal Revenue Service, just for the use of using your own dollars that you've saved over the course of time. And, IRAs, 401ks are wonderful aspects for creating and saving money and whatnot, but sometimes we need to, implement some strategies before you start making big withdrawals or passing them on to your children. And, like, for example, I'm 58 years old in our peak earning years. Okay, the last thing I want to do is inherit an IRA and add more money to that. I'd much rather inherit a Roth IRA. So if you look at my parents, for example, converting to a Roth IRA would make sense for them on money that they plan to pass on to someone anyway, because they're in a much lower tax bracket than what the beneficiaries could be.
Again, Chris, proper planning, seeing these things not once, not going through it the first time on our own, but having the benefit of the experience of a qualified advisor who's seen them many times over, can identify where we may encounter these various factors, these additional tax savings opportunities, and then planning and executing on how to control that. That is the benefit, ladies and gentlemen, of having that game plan for retirement. And Chris, now may be a better time than ever to look at this. Day one of retirement, year one of full retirement, that's probably the lowest income level that we will have for the duration of our lifetimes. And right now, at least for the near future, as tax laws stand, the next 3 years, we are in one of the lowest tax environments in history.
Yeah, no question about it. In 2026, things could certainly look a lot different. We've got a pretty big election coming up in 2024. We don't know who's going to be in the houses of power, and with respect to what could happen with potential tax changes, what will happen to what they call the Trump tax cuts that expire in 2026 and tax brackets change or revert back to where they were 10 years ago, like in 2015, for example, versus where they are currently at. Like Peter said, great time frame here in the next couple of years to do at least some sort of tax planning. And, depending on how much money you have, how many beneficiaries, what you plan to do with it, are all very important factors. For some folks that I talk to, they might have 4 kids and they're going to leave them, $300,000, for example. They can take that money out over a 10-year time frame. Do they need to convert that to a Roth? That would be an argument. You could make arguments on both sides of that. Depends what they do for a living, the kids anyway.
Let's make sure that we are just planning appropriately and identifying where we may encounter these various levels of tax and where we've got the opportunity to keep more of our money for our own selves during our lifetimes and generationally to pass to our family, our loved ones. That's what planning is all about, ladies and gentlemen. This can be a significant impact if not planned and properly addressed. It can be a significant benefit if you do effective planning. So pick up the phone, give Chris McIntire a call, 800-868-1194, 800-868-1194, 800-868-1194. Chris, as our resident self-proclaimed tax geek, we appreciate you continuing to remind us that this is important and addressing these issues.
All right. Well, thanks, Peter. Thanks, everybody. Have a great weekend out there. Thank you for listening today.
Tune into Chris McIntire's full radio program and visit McIntireRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris McIntire. Be sure to subscribe.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.